Okay, so we're going to use a multi-column journal. If you look at that journal, you've got several columns. You have some special columns for cash and for sales. You can see if you're looking at cash, you've got a column for debit and a column for credit. Okay, and then for sales, you've got just a credit. Okay, think about all the transactions that we've done. Which account have we used most often? Cash, right? So that's kind of the reason to go to a multi-column journal like this, is so that you don't, it alleviates you having to write cash all the way down the page because you use it so much. So it gives you those special columns, right? Sometimes we're getting cash, sometimes we're paying cash. So you have cash debit, cash credit. And probably the second most often used account is sales, at least for our purposes. So sales has its own special column as well. Does sales ever have a debit? No. Okay? Caveat, unless we make a mistake and we have to correct it. Okay? But in a normal transaction, you either have zero sales or you have positive sales. You don't ever have negative sales, right? Your sales don't ever decrease in a transaction. Okay? So there's only one column there. There is no debit column for sales because we're not going to use it. So it doesn't need to go in there. Okay? So we'll use the journal. The action is called journalizing. So you'll have instructions, journalize the following transactions. Means you're recording it in the journal. Okay. Again, talking about it, we talked about the special columns, the special amount columns. Later on, we will actually change and we'll use, instead of special columns, we'll use special journals. So we'll have a separate page for all of our sales. We'll have a separate page for all the cash coming in. We'll have a separate page for all the cash going out, and so on. Okay, but that's not till like March. Now we're just going to start with special columns. This helps us with accuracy as well, making sure we've got one debit, one credit, we've got it in the right accounts. All of our transactions need to be in date order. Okay, so it's kind of crazy if you skip one of your transactions and then all of a sudden you're looking and you realize I missed something way up here. Okay, that's where that pink pearl eraser comes in. Try to pay attention to all your transactions and make sure you're not skipping one. Okay, sometimes we can fix it depending on what the transaction looks like and what the page looks like. So you can always ask me about it, but pay attention, try not to skip any transactions. Okay? Double entry. Every number's going in 2 times. We have a debit and a credit every time. Sometimes we'll have 3 debits equal 1 credit. Okay, but as long as the total number is matching debits and credits, then we're good. Debits equal credits. That's double entry accounting. Okay? Every transaction will have that. Okay, we're also going to talk about source documents. Okay, that's this section down here. Okay, this is our first accounting document, but our source document is actually where our transaction starts. Okay, so you can see number 1 up there is actually collect the source documents. That's taking the receipts, taking the bills, writing the check. Those pieces of paper are our source documents, and that's what we must actually always start with. We can't just walk in and say, this is what we're going to do. Okay? We have to get it on paper. We have to have evidence, which is our concept that we'll get in this week on our yellow sheet of the objective evidence. It's the evidence that the transaction actually took place. We have to have that source document. Okay? The next couple of pages in your book actually show you examples of source documents, at least the source documents that we're going to use. So writing a check. If we paid cash for something, we wrote a check. So that check is our source document. Okay? A personal checkbook, if you have one, if you've ever got one with your account, then you may just have a checkbook where you tear the full check out. But most business accounts have a check set up where it has a check stub. It could be across the top, or it could be over here on the left. But we tear the check out and we still have a piece left in our checkbook that helps us keep track and document the information from that check. Because that check's going to go away, right? We may or may not ever see that check again. But we have to have the information from it. And so that's what goes on the check stub, which matches up with our source documents. Okay, sales invoices. This is when we're making a sale. We're Delgado Web Services. Okay, we sold to Main Street. All right, so we're not just looking for the number. We also need to pay attention to everything else that's on the sales invoice. Make sure we're getting the correct person we sold to. Make sure we're getting the correct amounts. We can see that this is due in 30 days. So this is how we know they're paying us later, right? It's due later. It's not due right now, okay? So that's on account. Sold services on account right there. Sales invoice. That's your source document for that. This is a receipt. This example right here, this is actually from Michael Delgado. This was the investment in the company. So this is coming out of his personal account, which we don't care about, but we're recording it into the business account. So he's giving us $2,000. We're going to give him a receipt. He'll keep that receipt for his own records, but we'll also have a piece or a copy of that receipt as our source document for that. Okay? We may have memos. So sometimes maybe we don't have the actual source documentation. We didn't get a bill from the company. I don't know. There's different things, okay? If that happens, we need to write it up and explain it. And so that can happen in a memo, in just a little memo form or format. But at least it's explanation on paper as to what that transaction was about. Okay? Everything has to be on paper. And then this last one is what they call calculator tapes. Most of the time I call it like cash register tapes, because to me that makes more sense. Somebody walks into your business, maybe they walk in with their computer and you do something right then and they pay you cash and you stick it in the cash register. So on that day we pull the cash register cash out and we record it. So that transaction would be sold services for cash. Okay, you'll have some kind of cash register tape or calculator tape that looks something like a receipt that you would get at the store, okay, out of a cash register for that source document, for that transaction. Okay, so those are just some samples, some pictures. The details are going to be important, and we'll talk about details. Don't skip the details. This is an actual permanent accounting document. This is an auditable document. What do I mean when I say auditable? What does audit mean? Not take away. Yeah. Yeah, to check it, right? So a company may have auditors come in to double check their books, especially companies that have stockholders. They want to bring in an outside person to come in, check their books, make sure they're verified. That gives the stockholders confidence. Maybe the IRS or maybe a judge says, we want to see your books. So they send an auditor in to double check the books. So we're talking about details. We can't leave things out because that throws up red flags for auditors. Okay? And we don't want to throw up red flags if they're not really there. Okay? So one of the things we're going to talk about, and you'll have to look at, we're going to have all these little boxes. If it's an even $2,000, we have to put the 00 in for the cents. Don't leave things blank, because then they'll wonder, did they just leave it out? Is it supposed to be 53 cents and they forgot to write it? Right? It just throws questions into their mind. Okay? So we don't want to leave things blank. We want to have a full transaction and all the pieces there. Okay? So I'm going to talk about little things like page numbers and dates and cents. Those have to be there. Okay, it's important to accountants. Accountants are detail oriented. All right. So we're going to actually start with transactions from the book. If you want to follow along, we're going to start here on 62. There's good pictures of the T accounts as well. Don't be afraid to go back to the T accounts if you're not sure. Okay, if you were good at the T accounts, go back to them if you need to figure out what the debit and what the credit is. Okay, because you have to know that to put it into the journal correctly. Okay, so we're going to go through these on the handout that I gave you. And of course, this is going to be our notes page, so we will add some notes to it. Again, things are important, details are important. These page numbers right here are important. Your instructions will tell you you're working on page 1 of the journal. You're working on page 10 of the journal. Okay, so whenever it tells you, you make sure you put that page number there. I'll take the points off every time I see it missing. Okay, so those page numbers are important. Page 1, page 2. Okay, this journal is a permanent record. This is our kind of our base document for all those transactions. This is where it starts. If we have to go back further, we can go back to the source document, but if everything's in here correctly, we should be able to build the whole rest of the accounting cycle off of this information. Okay, so this is our permanent record. It's our first official accounting document we're working with. Okay, there are some must-haves for every transaction. Okay, so we're going to write that down. For every transaction, we must have the date, a debit, a credit, and the source document. Okay, so the date must be there. We must have a debit, and our debits must equal our credits. And then we have to have the source. Okay, the source document is going to be right here, where it says doc number. That column is where we're going to put that in. Debits and credits go here with the dollar amounts. Our date's going here. Okay, and then of course we have to know what accounts they are, so we'll have account titles there. Okay, and the date must be in order. Okay, we have our special columns. Again, sales, cash. So when we use the general columns, that's for anything else that's not sales or cash. We have to know what accounts are being used, what these numbers match up with. So this matches up with the account title here. Okay, so the general here matches up with the account title here. The numbers here match up with this account. Okay, now if you struggle a little bit with the plus and the minuses on different sides, you can on these, especially these special columns, go ahead and add pluses and minuses. You can't do it for general because those are different accounts all the way down. But for sales credit, is sales credit a plus or a minus? Plus, okay? So if you want to put a little plus in there to help you along the way, you can. Start out that way with your journal. Okay? Cash debit, is that plus or minus? Plus. And cash credit is your minus, right? Okay, so we'll just start. First transaction, January 2nd, received cash from the owner as an investment for $2,000, receipt number 1. That's our source document. When we start a page or start a month, we need to start over here, and you have to write small, with the year, so 2019, January, all has to fit in that little box, and then we are on January 2nd. Okay? Can you see what that looks like? I can't see. 2019, January goes there. The day goes there. From this point on, we don't have to keep writing January or 2019. Okay, if we change months, we'll have to change it to February. Okay, if we go to another page, we'll have to write the 2019 in January again. Okay, but now we can just write the day of the month. All right, so received cash from owner as investment. What two accounts are being used? Cash and, okay, what's the actual account title? Capital, right? Okay, so received cash. Cash right here, plus or minus? Plus $2,000. Okay, that's what we want it to look like. You got to get the double zero in there for your cents. These will have one digit each. If you had, $10,000, the 10 would go here. If you had $100,000, the 100 would go here. Each of these would have one digit and then the double zero for the cents at the end. Okay, so that's one account, cash debit. What's our credit? Capital, right? Michael Delgado, capital, which is owner's equity. You're right. Remember, chart of accounts. If you ever need to go back, find the chart of accounts. Here we go, Michael Delgado. That's our capital account. Okay. All right. And that's our credit. So now we've got all the pieces. We've got the date, the debit, the credit. Oh no, we don't have the source document. Check receipt number 1, R1, right there. Okay, so that's how the transactions actually go into an accounting document. Yeah. Any questions on that? Okay, so now we're just going to go through different kinds of transactions. Filling this in. Second one, January 2nd. Okay, so it's still in the second. We do need to put the 2 in there. Paid cash for supplies. So what two accounts? Cash and supplies. Paid cash, so cash is decreasing for 165. And supplies is our account for 165. So we're increasing our supplies with a debit. That's an asset. And it was check number 1. So C1 is what goes under document number. Good? All right, so we're going through the chapter. So now to page 65, paid cash for insurance. The two accounts are cash and prepaid insurance. And we're on the third. The source document number, what would the source document number be? Check 2. C2. Prepaid insurance is an asset. It's increasing, so that increases with the debit. $900 is our amount. And cash is decreasing, right? We paid cash.
You said this is January 3rd?
Yes. All right, turning the page. We're on January 5th. We have bought supplies on account from Canyon Office Supplies. $220, memorandum 1. What two accounts? Supplies and accounts payable for Canyon Office Supplies.